We know that high inflation exacts a toll, particularly for those less able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to achieving our statutory goals of maximum employment and price stability. We will use our tools to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched. What we have now is a mismatch between demand and supply. We have very strong demand in areas where supply is constrained, particularly around goods, particularly around things like cars. So we have to, how are those two things going to get into better into alignment? Well, part of the answer is going to be through shifts in demand, and we think that part of it will be through the return of greater supply. So I don't think we look to get all of the realignment between demand and supply through the demand channel, although we should get some. But at the same time, we do think we'll get, over the course of this year, return to normal supply conditions, and that's going to affect our policy. I will say, though, if we see inflation persisting at high levels longer than expected, then we will, if we have to raise interest rates more over time, we will. Wages moving up is generally a good thing, but if you look back through history, there are times when wages have moved up in a way that has fostered persistent inflation, and that hurts everyone. It particularly hurts people on fixed incomes. So we don't see that right now, but we do see these are the biggest wage increases in decades, and so we're watching carefully. And to the extent we are looking at this year, what we see is an economy where the labor market is recovering incredibly rapidly, really beginning around the middle of last year. The unemployment rate's been dropping at more than 0.3% per month since last June. It's now below 4%, which is pretty close to half-century lows. So that part of the employment market is doing very well. Meanwhile, inflation is running very well, very far above our target. And what that's telling us is that the economy no longer needs or wants the very highly accommodative policies that we've had in place to deal with the pandemic and the aftermath. So that's what that's really about. We're really just going to be moving over the course of this year to a policy that is closer to normal, but it's a long road to normal from where we are. Right now we are very highly accommodative, and it is really time for us to begin to move away from those emergency pandemic settings to a more normal level. It really should not have negative effects on the employment market. Price stability is half of our mandate. There's no basis in the law for preferring maximum employment over price stability or vice versa. They're equal. However, at different times, one of them is farther away from its goal, and that's the one we need to focus on a little bit more. Sometimes that's maximum employment, sometimes it's inflation. I'd say now it's inflation. So on inflation, why do we say transitory? We said that because we thought that these supply side bottlenecks and shortages would be alleviated much more quickly than they have been. There's no empirical experience with this before. We haven't had the global supply chain collapse. We haven't had this kind of a labor force shock before. So we and essentially all other mainstream forecasters forecasted that by now we'd be seeing much lower inflation, and that's not what happened. So what's changed is that, just as I mentioned, the supply side constraints have been very persistent and very durable. We're not seeing really a lot of progress. If you look across, the global supply chains and what's happening domestically, look at our ports, look at Long Beach and LA, the two big ports on the West Coast for Asia. The number of ships at anchor is still at a record level. So we're not really seeing yet the kind of progress we essentially all forecasters really thought we'd be seeing by now, and that's really what's driving it. I think we did foresee the strong spike in demand. We didn't know that it would be so focused on goods, but so that's really what happened. And so I think we learned that. It wasn't that, it was just, this is a unique set of circumstances. We'll be normalizing policy, meaning we're going to end our asset purchases in March, meaning we'll be raising rates over the course of the year. At some point, perhaps later this year, we will start to allow the balance sheet to run off. And that's just the road to normalizing policy. That's what we're going to be doing. And of course, we're committed, but we also we do believe, and I think widely it is believed that these supply blockages will be alleviated too. The level of job openings is at an all-time high as a percentage of the labor force. The level of quits labor economists look at the level of quits as a real indicator of how strong the labor market. The percentage of quits, the number of quits, is at an all-time high. So the problem is not lack of demand for labor. The problem is that there's a significant supply problem, which is associated with the pandemic and a range of other factors. Participation has not recovered, but as you can see, for people who are in the labor force, the unemployment rate is dropping at historically fast levels. So we don't have a labor demand problem to solve through our policy. What we have is a labor supply problem. So what is the threat? We're clearly on a path to have an even better labor market over time. What are the big threats to our getting there? Well, I would say very near the top of the list is the threat of price stability. If inflation does become too persistent, if these high levels of inflation get entrenched in our economy and in people's thinking, then inevitably that will lead to much tighter monetary policy from us, and it could lead to a recession, and that will be bad for workers. So really, achievement of maximum employment, by which we really mean continued progress in hiring and in participation, is going to require price stability, and that's going to require us to use our tools to the extent they work on the demand side, while we also expect some help from the supply side. This year, 2022, will be a year in which we take steps toward normalization. That will involve raising the federal funds rate. That will involve ending asset purchases in March. And perhaps later this year, depending on the run of things, we would also see ourselves beginning to allow the balance sheet to shrink. So that's what I think that's the broad picture of what I see happening. The committee hasn't made any decisions about the timing of any of that, and I think we're going to have to be both humble and a bit nimble. Right now, our policy is very highly accommodative, so we're stimulating. We're not restraining demand at all at this point. We're encouraging it. We're trying to get to a place where we're more neutral and then perhaps tight if that's appropriate.
To what extent do you think, and give me an idea of discussions that you're having at the Fed to have a faster taper in lieu of a rate increase?
We haven't made any decisions. We had our first discussion of these issues about runoff, and as you mentioned, there are a number of different pieces to talk about. We had that at the December meeting. I expect we'll talk about it again at the January meeting. As the world's reserve currency, demand for our paper is very strong. If you had shown that and then asked somebody 15 years ago to predict what interest rates would be, they wouldn't be predicting that the 10-year would be at 175.
No.
Right, so there've been a lot of demand.
But they would have predicted that the debt was going to go up.
They would have looked at that picture and said, well, you must be experiencing difficulty borrowing, but we're not at all. So, no, we're on an unsustainable path. Debt is not at an unsustainable level, but the path is unsustainable, meaning it's growing faster than the economy, meaningfully faster than the economy. We have to address that over time. We will address it over time. And the better way to do it is soon and to do it in good times. Start when the economy is strong and the taxes are rolling in. And that's since we don't do fiscal policy, but I will say that the sustainability of the debt is something we need to get back to and focus on again.